You buy a stock. It tanks. Instead of cutting losses, you tell yourself, I can't sell now. I've already put so much into it. So you double down, hoping to make it back. Sound familiar? That's not strategy. That's the sunk cost fallacy. Today, we're breaking down why traders cling to losing trades and how to finally stop digging deeper holes. Every trader has been there. You enter a position with conviction, maybe even excitement. You've done the research, you believe in the stock, and you're sure you'll be rewarded for your patience. But then, the market has other ideas. The price drops. Suddenly, your solid plan looks shaky. Instead of reevaluating, you start thinking, I can't give up now. I've already invested too much. This is one of the most dangerous mental traps in trading, the sunk cost fallacy. It's when we make decisions not based on what's happening now or what's likely ahead, but on what we've already put in, whether that's money, time, or emotional energy. It's like staying in a bad movie at the theater because you already paid for the ticket, even though you're miserable watching it. In trading, this mindset can be devastating. Doubling down on losing trades, holding on to positions long past their expiration date, or refusing to take a stop loss. It all comes from the same flawed reasoning. And while the sunk cost fallacy is part of human nature, it's also one of the easiest ways to wreck your account. So in this episode, we're going to dig deep. We'll explore why our brains hate letting go, real-world examples of traders who doubled down until it hurt, and practical ways to avoid turning a small mistake into a financial disaster. By the end, you'll learn how to reframe your decisions. So instead of asking, what have I already lost? You'll start asking, what's the best move from here? That shift can change everything. Before we continue, I want to thank the sponsor of today's video, Noesis. Noesis is a platform built specifically for traders who want to level up their consistency and mindset while avoiding mental pitfalls. It gives you tools like a daily mental check-in, a trade journal, and an emotion wheel to track your state while trading. On top of that, it includes structured playbooks, which are strategy checklists that you can go through before and after each trade, plus a playbook marketplace where you can explore proven strategies from other traders or share your own. If you're serious about developing the psychological edge that most traders ignore, Noesis is worth checking out. You can get started today at noesis.zone. Link in the description. What the sunk cost fallacy really is. The sunk cost fallacy isn't just a trading problem, it's a human problem. Psychologists define it as the tendency to continue an endeavor once we've invested resources, even if future outcomes don't justify it. Think of it like this. You're at an all-you-can-eat buffet. You're stuffed, but you keep eating because you paid for it. That's sunk cost thinking. You're not eating for enjoyment. You're eating because of what you already spent. In trading, this shows up when you hold on to Apple after a bad earnings miss, telling yourself, I can't sell now, I'd lock in a loss. The market doesn't care what price you bought at. That money is already gone. The only thing that matters is Apple a good buy today at this price? If not, your decision is clouded by sunk costs. Real-world example, doubling down. Gone wrong. Let's look at a scenario. Imagine you bought Apple stocks at $190 before earnings, confident that iPhone sales would crush estimates. Instead, Apple reports slowing growth, and the stock drops to $175 overnight. Your plan was to cut losses if it dropped below $180. But when it does, instead of exiting, you convince yourself, it's Apple. It'll recover. Plus, I've already lost $15 per share. I can't quit now. So you double down at $175. Now you've got even more exposure, but the stock keeps sliding. $170, $165. Suddenly, your investment is a full-blown hole. Here's the key point. The decision to double down wasn't based on fresh analysis. It wasn't about Apple's fundamentals or the broader market. It was about not wanting to feel like you wasted your initial $190 entry. That's the sunk cost fallacy in action. Many traders make this mistake. Some survive it. Others blow up their accounts. Why our brains hate letting go. So why do we cling to losers? It comes down to psychology. Loss. Aversion. Studies show we feel the pain of losing about twice as strongly as the pleasure of winning. Selling locks in pain. Holding feels like hope, ego, and identity. When you enter a trade, you've put your judgment on the line. Admitting a bad call feels like admitting you were wrong. Doubling down feels like defending your honor. Effort. Justification. The more time and research you put into a trade, the harder it is to walk away. You convince yourself that effort has to pay off. These psychological forces are powerful, but they're not reality. The market doesn't grade you on effort. It only responds to supply, demand, and price action. Common pitfalls of sunk cost thinking. Holding through obvious red flags. A company issues poor guidance, the chart breaks down, and you still hold because I'm already in. Adding to losers without a plan. Averaging down can be a legit strategy in long-term investing, but in short-term trading, it's often just denial dressed up as conviction. Ignoring better opportunities. By clinging to a loser, you tie up capital you could use in stronger setups. You're not just losing money, you're losing opportunity. How to fix it? Practical tips. Reframe the question. Instead of asking, how do I get my money back? Ask, if I had no position, would I buy this today? If the answer is no, that's your sign to cut it. Use stop losses. Religiously. Stop losses are like guardrails. They take the emotion out and keep you from tumbling down the sunk cost cliff. Place them before you enter the trade, not after things go south. Predefine your exit rules. Write down, if XYZ happens, I'll exit. Maybe it's a technical level, maybe it's earnings risk. The point is to decide when you're calm, not when you're panicking. Separate ego from outcome. Your worth as a trader isn't tied to one trade. Professionals cut losers fast, not because they're cold, but because they know survival matters more than being right. Track your behavior. Keep a trading journal. The sponsor of this video can help you with this. Remember to check noesis.zone out to improve your trading mindset and your strategy. Note when you broke rules, why you stayed in, and how it felt. Over time, you'll spot patterns and break them. When averaging down does make sense. To be fair, there are moments when adding to losers isn't just sunk cost, it's strategy. Long-term investors sometimes average into quality stocks during downturns. For example, someone who believed in Microsoft's long-term future during the 2000s tech slump could buy more at lower prices and profit over decades. But here's the key difference. Averaging down works when the company has strong fundamentals and the investor has a long horizon. If you're a trader looking for short-term momentum, averaging down on a falling stock is usually just feeding the sunk cost fallacy. Takeaway: approximately 1,000 characters. The sunk cost fallacy is sneaky because it feels rational. I've already put so much in, I can't stop now. But in trading, that's the exact thinking that traps you. Remember, the market doesn't refund you for effort. It doesn't care how long you've been holding. The only question that matters is, what's the smartest decision from here? Cutting losers quickly isn't weakness, it's discipline. And discipline is what keeps traders alive long enough to win. So the next time you feel yourself clinging to a trade just because you've already invested, pause. Reframe. Ask yourself the hard question, would I enter this trade fresh today? If not, you know what to do. Thanks for watching this episode of Trading Psychology Pitfalls. If you've ever doubled down on a bad trade because you already put too much in, you're not alone. We've all done it. The key is learning to spot the sunk cost fallacy before it costs you more. If you found this helpful, hit like, drop a comment about your own sunk cost moment, and subscribe for more episodes. Next time, we'll explore another sneaky mindset trap. Revenge trading, when emotions, not strategy, take the wheel. Until then, remember, bad trades don't define you. How you handle them does. Cut the cord, save the account.